problem number 3, and we'll do it here in a PowerPoint presentation so it's easier to understand and we can go through step by step. First thing we're going to need to do is find our income from continuing operations before taxes. In the book they give us a beginning income of continuing operations, but they hadn't taken into account the 6 irregular items that they listed, so we'll go ahead and do those here. First one we want to do is we'll take out this loss on the sale of securities out of that income. Then we're going to add a gain on the life insurance policy, and all this number represents here is the net of $150,000 subtracting the $46,000 initial investment, and so we have this net gain of $104,000. Finally here there is an error in the depreciation calculation for the equipment. They forgot to take into account the salvage value of the equipment, and by doing that they recorded it as $9,000 when it should have been $7,500. So we need to add back in that $1,500 extra that was recorded on the depreciation, and this gives us our adjusted income from continuing operations before taxes. Next thing we need to do is find our income tax expense. First thing we'll do is just take this $838,500 and just drop it right here. We'll go down here. It mentioned in the book that the gain on the life insurance policy was non-taxable, so we need to take that out of the income so we don't get taxed on that. So we subtract that and we get our taxable income here of $734,500. We'll multiply it by our simple tax rate of 30%, and then we'll get our income tax expense of $220,350. So this is what our income statement looks so far for Meijer Incorporated. We've got our income from continuing operations before taxes, then our income tax expense, and that gives us our income from continuing operations right here. So the next thing that we need to account for is this discontinued operations. There was a loss on the disposal of the recreational division of $115,000 that we need to account for. One of the nice things about a loss, if there are any, is you can take away the income tax expense that would have been associated with that. So we can take those $34,500 out of the $115,000. We only have to record this $80,500. We'll take that $80,500 from our income that we listed previously, and that'll give us our income so far of $537,650, excuse me. Okay, so next there was an extraordinary item. There was the loss from the flood, and this may be the only time you're grateful that there was a 46% income tax rate. So the tax lost was $41,400, so we take that out of the $90,000, which we get $48,600, and we subtract that from our last place on the income there, $537,650, and that gives us our net income of $489,050. So altogether, this is what the income statement would look like. You've got your income before your taxes, the income tax expense. Here's your income from continuing operations. Then you put your discontinued operations in, and that's your net income after that. Then your extraordinary item, and finally here's your final net income. The last thing it asked us to do was to calculate the earnings per share. So you've got your net income minus preferred dividends over common shares outstanding. Since it didn't record any preferred dividends, we don't really need to worry about that in this problem, though we should look out for it in others. So you take our net income of $489,050 divided by 120,000 shares outstanding, we get $4.08. Just a note on that irregular item number 6 where they talked about changing methods to the FIFO method. Since FIFO was used all of 2012, there was no change necessary in the income statement. However, changes in previous years would have been reflected in the retained earnings, which we didn't have to find in this particular problem. So hopefully that helps on problem number 3.